we're good to go. I think if we can see it on LinkedIn, we should be fine.
I think we can.
Yeah, we're good.
Good.
Yeah, I've got it recording on my end.
Okay.
Thanks everyone for waiting.
Yeah. Okay. I'm like waiting to give people kind of just like a few minutes. Maybe I'll do some pre-event brief. Hey everybody, thanks for coming. We'll get started shortly. I've prepared a couple of slides that I'll kind of like talk through. I'll keep it pretty short and brief. I just want to give some context for like what our process is, what we look for, and all that stuff. But I would love the majority of the time to be taking questions from all of you. So whatever questions you have about what we look for in startups, even questions more generally about what investors look for, I think are kind of like free or like games. So at any point, I think just like put questions into chat, and then Madhu will kind of like stop me and he'll kind of like moderate a bit. So feel free to just at any point we're talking, put questions in chat, we'll get to them. Yeah, I think that's it. Should I get started, Madhu?
Yeah, we can. People are slowly streaming it, so I think we can kick it off.
Okay, great. All right. Getting into iterative, 5 easy steps. Just kidding. There's no easy steps to this. I think getting into iterative is very similar to getting into like getting an investment from a venture capitalist. There's nothing that, to me, I don't think there's like anything that we look at that a traditional venture capitalist would look at, or vice versa. We probably would just invest in like much earlier companies, and we probably have higher risk appetite. But I think everything I'm about to say, I think is, I would say to companies like in our batch, we're raising from, venture capitalists at seed stage 2. Okay. First part, I just want to talk about our admissions process. So this is our process. It's pretty short. We've done this in like under a week, if need be. Actually, we've done this in a couple of days. People apply online, so we get these applications. And then there is a few people who tend to be our founders, actually, who've been helping us review applications. And so some number of kind of applications will be reviewed by like 3 or more people, and they all give in their independent input. Based on that input, we triangulate and we kind of make sense of who we should take a first call with. Those first calls go to a venture partner. Those venture partners are either founders that have gone through iterative or are people that we kind of like know in our network, and they take first calls. Then after those first calls, they write feedback in an Airtable form. And then that, if the feedback is positive, I actually review every first call. So every first call that applicants go, I will read the feedback from those people and review the applications. And then if we decide to push it to a second call, those second calls will happen with a general partner, which is either Brian or I. It used to be that for all second calls, both Brian and I were on the call, but we've recently split it up. So only Brian and I, only one of us needs to be on a call. Just we've been getting so many applications recently. We just like both can't be on a call. After you do a call with either Brian or I, we just make an investment decision. And then that's it. Maybe an interesting thing about our admissions process that isn't obvious here is by the time that you get to a call with either Brian or I actually have looked at all the feedback everybody else has given. So by the time I look at an application, I've actually looked at like 3 or 4 different people's kind of like impressions and kind of like feedback on that application. And then I'll do the call. If you do a call with either Brian or I, only one of us has to like the deal to invest. We are not consensus driven. In fact, Brian and I fight a lot about who we should invest in and who we should not invest in, and we like don't agree oftentimes. I think the surprising thing that we found out is the companies that we agree on, probability of success is pretty high. Like, okay, they do pretty well. The companies that we don't agree on, the probability of success is lower, but the magnitude of success is higher. So on some level, it's like when we don't agree, we're wrong more of the time, but when we are right, we're like really right. And so actually some percentage of our portfolio, we're like consciously trying to build for basically decisions that we disagree on. So we're like building in disagreement into our investment process as much as possible. Yeah. So I think the first call with a venture partner is only 30 minutes. The second call with a general partner is only 30 minutes. And then we make an investment decision from there. Maybe let me pause here for a moment, Madhu. I don't think there's any questions in kind of like chat, but let me just pause in case people have questions.
Okay, people, I think someone's asking, do we look into Web3? You want to just answer the questions of like, what we look at, what we don't look at?
I actually have that in some subsequent slides and stuff.
Okay.
But we look at all Web3 is no different to us. Like we look at all Web3. We've invested in a couple Web3 companies. If you want to know what they are, Katarina is one that we've invested in, has done quite well. Cover.io has done pretty well. And so we've invested in a couple Web3 companies already. Yeah. So we like them. There's one in Dispatch that's a Web3 kind of dev tools. Yeah.
We can go on.
Cool. And if people have questions about the process as we go on to, feel free to add it in there. Okay. We just pulled this today. As I said, every time somebody touches an application, they actually fill out a feedback form, and there's different reasons in the feedback form, and we kind of like are triangulating. And then based on that, if we're going to reject an application, we actually try to tie a reason to it, and we'll send the rejection on that. But then we can kind of like see, okay, if we're rejecting lots of people, what are we rejecting people for? Like, are we over indexing on something and all that? So I actually just pulled this today. I think this is just for this batch of applications. I don't know if it's for I think it's this batch. So this isn't kind of like all historic. So these are the reasons. Let me go through each of them, and so that I can kind of like talk through kind of like why some of these are so much and what these all mean. Okay. The highest reason is other, which I always think is interesting. And the reason why it's other, reasons get put under other is for a couple of things. One, I do think startups are so unique that oftentimes there's just not like a canned answer that really kind of like explains why we're passing on a startup. And so, 42% of the applications that we pass on, we actually end up writing something unique and about why we're passing. So this is something that we try to do, but obviously we can't always kind of like do it. But startups are just so unique. We end up having to write something kind of personal in order to kind of get it across. The other thing too is other is the thing we kind of like use as like, it's the obvious catch-all, right? For the rest of these. So I think you'll just see that there's just like a lot of reasons why you would pass on one. Okay, not enough validation. I think we'll misinterpret this reason often. And if you get a pass email from us, it's actually coming from me. And so when you reply to that email, it actually replies to me. So I see everybody who's kind of like, what is this? What does it mean when you're like not enough validation? So I feel like I get to see a fair bit of people's responses to these. What it means by not enough validation is a couple of things. One is oftentimes we see people who kind of like, validation is like a fuzzy word, and this is why we ran a whole program around it, but we like to see validation that is kind of like real life validation, as in not surveys, kind of like not customer interviews, not that XYZ person said they would use it and they're very excited about what I'm building, but like, did somebody make a landing page? Did somebody get users? Is there an MVP going? Is that growing? Like, to us, kind of like experimental evidence that this is like true is what we're often kind of talking about. I often find that people say things like, oh, it's going to take me 6 months to make an MVP before I can kind of validate. And I often kind of like try to tell them, and I think we've actually built this into the answer, that you can often validate an idea in kind of like a week or a month max. And so if you're waiting to kind of build some like whole product, I think you're actually kind of like waiting too long. And so to us, validation is everything that kind of like fits around this. It could be that validated in a way that we kind of like don't think of as kind of like put much stock in validation, like surveys. We don't really kind of like value surveys very much. Or we think that you are building this MVP, but kind of taking quite a long time, and we think you can validate in like a much shorter period of time. So that encompasses the like not a validation part. Okay, Madhu, I see some questions. You want me to start there?
Yeah, I think the first one you can start with, because we're on the topic, is someone's asking, does validation mean traction?
Yeah, they are kind of like, there's not great definitions for all these start, like product market fit, traction, kind of like validation. Like there's not great definitions for this. And so I think these get together. I think traction and validation are similar. And so I think traction is evidence that you have validated an idea. And so I think they're kind of like cousins of this. But I think the similar things that you would show for traction is the similar things you would show for kind of validation. So similar.
Okay. This is a pretty interesting question. So Nino is asking, are the percentages of like the rejection reasons different at each stage of application? So I guess you're talking about, for example, at just the application review stage, most of the rejections are because of lack of validation. And then as you go down funnel, is it more or something else?
Yeah, that's actually a really good question. June, I think you're in this call. Actually, that would be a good thing. We're going to like make a post about this. And so I actually think this would be a really great thing to dig into more. I don't know the numbers off the top of my head. There is a difference though. So I think, for example, that the insufficient information and the not enough validation tend to be reasons that we use to screen at the first stage. So those happen typically at the application review process. And so I think those happen earlier. The not enough differentiation or market too small tends to come at the first call with venture partner stage, I think. And then almost all of the like passes that we send from general partners, I think are all kind of in other. So on some level, and I'll go through more of the reasons, but on some level, I think in an application, it's very easy to kind of see whether somebody has validated an idea. Like I kind of almost don't need to talk to them. Like I can kind of see it in the application. Differentiation is something that you really need to kind of like talk to somebody about and kind of dig into, because it's very nuanced. Something that I could think is not very differentiated, I could be missing some key piece of information that is like makes it super differentiated. So I think it's very nuanced. Okay, there's more questions and stuff. Answer some of the questions, maybe move through the reasons and then come back.
No, I think we can just answer a few of them. Does Iterative send out a rejection email rolling, or is it all in one day like YC?
Now rolling.
Okay.
Yeah. And basically we do rolling because we actually want to be able to get back to people within like 14 days. I actually think that's our internal kind of like SLA. You may not get through the whole process in 14 days, but you should hear from us in 14 days.
Okay, I think there's like a similar kind of thread of questions. So I'm going to try to batch them together. So people are generally asking, is it okay if, we're like really early stage, we're still like validating the idea. Should we apply now or later? And is there any examples of, companies that have been super early that we've invested in?
Yeah, you should just apply now. There's no harm in doing it. There's like, and Madhu knows this, he can, there's no negative points for people who have like applied before. That's not a thing. We also have invested in plenty of companies that we have previously rejected. And so we take a look all the time. So I think just apply. Oftentimes we get to, secrets we're putting here. There's a star button in applications for people that we pass on, but we think are quite strong or are working in a space that we're interested in and maybe are just like early or whatever. And then periodically, as we kind of, for the next batch, we will go through the people that we have started and kind of reach out to them. And so get on the star list, apply early, and we can kind of like get to know you a little bit. So there's no harm in that. We've invested in a number of companies that are like completely new products. I remember, I think Coverio, they literally pivoted, like they did a public office hours with me, literally pivoted that weekend. And then we invested in them like that Monday, like just started. And I think there's a games company, Artie, that was kind of like that too. Like literally there's no product. He's like building games out of a like text, and he was like doing it manually at first. And so, we invest all over the place. Maybe one thing that people should think about with stage, because I think they think about stage in a silo. If you are very early, that means you don't probably have that much validation, but maybe you do. And so if you don't have much validation, then I think for us to invest, we have to think the thesis and the hypothesis for what the company is doing, and needs to be really interesting. And we really need to kind of care about the founder, right? Because we don't have the other information. And so the other stuff needs to kind of make up for it. As opposed to, look, there's some deals that I've invested in where I don't really get why this is like a business or why this works, but the traction is just so strong. I'm kind of like, it's growing super fast. There's a thing that I just clearly don't understand here. And so maybe the way to think about it is investors think and I'm going to cover this, but they think in a couple different kind of like verticals, and they kind of like add it up in their head, and it like needs to be above a certain kind of like sum, like figurative sum, right? So if you don't have much validation, then your idea the investor really needs to care about, or you need to be really compelling to make up for the fact that you don't have validation, and kind of like vice versa. Okay.
We can move on for now. I think the rest are more general questions. So we're going to get through this section first.
Okay, cool. It's so weird to see my picture in chat, and I know it's you, but it's just like, I didn't see that. Okay. By the way, everyone, we'll get through the questions, so keep asking them. We'll just get through some of this. I might answer some of your questions. Okay. Not enough differentiation. This is something that I feel like we talk a lot about, and this happens a lot in interviews. And I think sometimes people get a little bit frustrated on kind of like what it really kind of comes down to. Really, for us, the thing that we are interested in is startups find themselves in two types of markets. There are markets where there are like no competitors, and basically then the question is, should this thing exist or not? Because nothing exists here, right? So there's no question of differentiation because there's no competitors. The question is just like, should this exist? And then there's the markets. This is most startups. They exist in a market that currently has people that are working in that market. And then the question is like, okay, why are you different than them? And bad differentiation reasons are like, we have better design. It's just like everybody claims that. It's like kind of like hand wavy, like, you know, like it's not clear that like better design is going to like win these things. A better version of better design is if you figure out that there is some unique aspect to this product in which other products are kind of like sleeping on and kind of like not investing in as much, and then you believe that like this is actually a really valuable thing that other people are not investing in, we're going to invest in that thing, and that's how we're going to win the market. Okay, cool. I may not believe that hypothesis, but that's like a real hypothesis that we can kind of like talk about. Just saying like, I don't know, we have better design. What are some other kind of like things? We're cheaper. We hate cheaper as a differentiation. This is Brian's pet peeve. Typically businesses don't win just because it's like a race to the bottom. It's like, okay, well, you're cheaper than somebody else. Do they win because they're cheaper? And then everybody just undercuts themselves until you have no profit margin. And the company is just kind of like dead, and it's a commodity. It's like, unless you're cheaper because of like some fundamental understanding that we like don't appreciate. Like, I don't know, you can build batteries at 1/10 the cost because you have some new science. It's like, okay, somebody's not going to just like figure that out. So differentiation is kind of like something we think about a lot in how to win markets. Insufficient information is, I think, always surprising to people. This doesn't mean that somebody left a field like unanswered. This was surprising to us. Madhu, I feel like you've done some reviews. This is probably surprising to you. There's a number of applications sometimes that we just don't understand what they do. We like don't understand the product. We like don't get what problem they're solving. We don't understand what they're doing. We don't understand like how the product works. Oftentimes those applications tend to be very buzzword heavy. And so they're just saying things like, we are going to be the leading AI Web3 company. Okay. It sounds great. But like, what problem does that solve? Like, what are you actually doing, right? Like we just like don't understand kind of like what it is. And so we'll market as insufficient information. And we're just like, look, we don't really understand what this company is about and what they're trying to do. The best way to explain what your company does is to just, it's maybe the mom test, explain it like you're explaining it to like your parents or just like people who are not in tech, right? There's like a very like cognizant, like very kind of clear way to do it. Don't say AI, don't say kind of like, I don't know, paradigm, like don't say any of that stuff, just like plainly, right? Like if you're gonna explain Grab, you could be like, oh, they run this AI to do matching. No. Grab is you go outside, you want to go somewhere, you push a button, a car comes and picks you up, it takes you there, you get out of the car, payment happens in the app, right? I'm not talking about technology. I'm not talking about any of those things. It's just like people want to get places, you help them get those places. This is how it works. So plain and simple. Okay, market too small. I'm going to actually talk about this in a further slide. So let me kind of get to this at the further slide. Technology is not a differentiator. This is kind of a tricky question, and we've been asking ourselves this a lot, is like we invest in technology startups, but the word technology has been blurring a lot recently. So it used to be just like you invest in software and hardware, but there's like a lot of different businesses now that are kind of like merging in all these. So the best way that we've kind of come up with it is that technology is not the key differentiator to the company. And what that means is that, again, back to the differentiation part is this company going to win their market because of some technology kind of like advantage or not? So we probably wouldn't invest in a company if the advantage to beating the market is like, I don't know, they're really good at hiring lots of part-timers. Could be a really good business. Like I'm not knocking that. Could be a really good business, could be very profitable, but like not the type of businesses that we invest in. If it was the same company and they're really good at hiring part-timers because they have this like app or have this platform or this like unique way to reach them through kind of like technology or something, okay, cool. That could potentially be interesting. But if it's like we send out a lot of people to like hire part-timers at, I don't know, on the street or something, then it's like, right. So for us, we invest in technology companies. So we want to see technology be like a core piece of the differentiation. So that's kind of like where that comes in.
I think there is a question, good question on this topic, which is like, must it always be that technology is a differentiator? Is it like an auto out if that's not the case?
There's very little absolutes at Iterative. And so I'm kind of like wary of kind of like giving absolutes, but I think for the most part that it tends to be kind of the differentiation. Sometimes there's like innovations in business models, which we kind of like debate, but we tend to kind of like try to stick for technology companies.
Okay. We also have this question, interestingly phrased. Does Iterative invest in businesses that grow slowly and sustainably initially with high growth rate upside down in the midterm in like 2 to 3 years time?
Seems very specific. It's hard to answer that question. I would want to understand why they're growing slowly now and then would grow faster in the midterm. So I just don't like what type, it's not obvious to me what type of businesses do that. I think for most of like traditional kind of like startups and Silicon Valley startups, they kind of just like, once you figure it out, it grows very fast and it continues to grow fast. So I would just want to understand what that is. Okay, let me pick out one thing because I want to get through some of the other stuff. We could spend all the time with questions. Christine had a question about leadership, founding team skills, all that stuff. Okay, here's the thing. We don't send passes and say it's the founder. Sometimes we think it, we don't say it. And the reason why I think that's challenging to kind of like say is, look, being a founder is really tough. And I don't know if I would appreciate an investor being like, hey, I would love to invest. I just don't think you're a very good founder. That's rough, right? Like, is that helpful to the founder? Is that constructive? Like, I feel like these reasons, at least, is like, we can like, it's something the founders can work on. It can be constructive and stuff. But if we're just like, I don't know, like your co-founder is bad, but we think you're like, we don't comment on kind of like personal kind of like things like that. And so we try to be as kind of like objective around this as possible. And so we just don't comment on kind of like founders and team and a lot of that kind of stuff. At least we don't kind of like say it. We've definitely in interviews and stuff kind of noticed friction between co-founders. And so sometimes we've passed on companies because we just don't think the co-founding team is going to like stay together. So that does happen, but we don't kind of like put it in as points here. It probably does, a percentage of them probably does show up in other, so because but we don't put that in emails and stuff.
I think we can move on for now. Yeah. I'll kind of like group a lot of the Q&A for once we're done with the slides.
Okay, so I just went through kind of like the reasons why we send rejections and passes. Let me spend some time talking about like, what do we actually look for, right? It's these three things. We are looking for, to me, a startup at its kind of like base level is centered around a problem, and they've developed a solution to solve that problem, and they are run by kind of a founder. And so we just look at these three things. I'll go into each of them in detail, but like, I just want to leave this on the screen to like, let it kind of like soak in for people. Is like, these are the three fundamental kind of like building blocks of startups. I think if you take any one of them away, it's just not a startup anymore. Right. And so I think these are the three fundamental blocks. These are the things that we kind of like look into the most. And so all of our internal feedback is based on this. It's some measure of problem, some measure of solution, some measure of kind of like founder. Okay, let's break them down. Problem to me is market. And so I oftentimes will kind of like talk about problems because I think the problem that you choose dictates your market, which then dictates your market size. Okay. Different types of problems here. So across the top, you see this annoying and painful. So for every person that has your problem, how painful is that problem? Right? Like I have some, okay, my life is quite privileged, but there's some things in my life where I'm like, oh, it's kind of annoying, right? And then there's some things that are like a really big pain. I will obviously kind of like use products that solve these big pains, but less likely to use annoying ones. Few people, many people. How many people have the problem? So obviously problems with lots of people have kind of like larger market sizes than ones with few. So if you construct this 2 by 2, the largest markets are the problems that have the largest markets are the problems that a lot of people have, and they are very painful, right? I mean, it kind of makes sense, right? Okay. The problems with the smallest market are problems that few people have, and they're just kind of annoying, right? The market size for these kinds of problems is just like pretty low. Don't work on these. Obviously, work on the ones with many people have and are painful. The other 2 quadrants, so the first one and the fourth one, I think these are interesting and we can debate them. This is my take. My take is that problems that few people have but are very painful for those people are more valuable as a market than problems that lots of people have but they're just like kind of annoyed by. The reason why is because at some point you're going to need to make money. And I think even if a few people have this very painful problem, those people are likely to be able to kind of like care about it, spend money, and kind of like want to seek out a solution for it. And typically there's like some target group that fits this. So you can kind of target that target group. If you are working on a problem that many people have that are kind of annoying, it's hard to find who the right target group is. Nobody really cares. And so it's just hard to build a base around. The example that I always give, and it's kind of facetious and kind of ridiculous, but bear with me. If you have a cure for cancer, it turns out actually few people in the population have cancer, but everybody who has cancer, it's like the biggest thing that that's happening in their life right now, right? So you could build, if you had a cure for cancer, you're like building like one of the largest companies like in existence, right? And so, but actually a few people have it, right? So I think it kind of fits in that one. So that's kind of like a lot of like healthcare stuff I think of as like few people, but very painful. They all kind of fit in this bucket. So yeah. The other interesting thing here is everybody that is working on many people annoying problems are trying to pitch their problems as more painful than just annoying. And everybody that's working on few people problems that are like really painful are trying to make the case that like actually lots of people have the problem. So everybody's trying to get in the top right quadrant. But this is how we think about market. So I look at market based on how the founder or the startup defines their problem, and then we extrapolate from there, kind of like which of these, and we make some kind of like estimate of like how painful, how many people have this, that kind of stuff. Okay, Madhu, you've heard me say this before. This is like my thing.
Yeah, I mean, this is awesome. Like I think we discussed this during like the fundraising bootcamp and like validation program both. And so this is great. Yeah. I think we can move on. Nothing related to this for now.
Okay, this one's a little bit trickier. So I'll talk about the solution a little bit, but the best way that I can kind of condense it down is the solution an order of magnitude better than whatever is happening now? So let me break this down. This is not as kind of like pithy as kind of the previous slide. Okay. Oftentimes we're looking at kind of like the competition, and rarely is a startup helping people do something that they cannot do today, at least maybe in a different way, but at least that they cannot do today, or it's something that they could like never have been able to do. So I don't know, like take crypto, for example. Crypto is not, okay, okay, I don't want to get into the crypto wars of this, but just generally, crypto and allowing people to send money decentralized is not actually allowing people to do something they couldn't do before. I can send Madhu money without crypto, right? So from the standpoint of like being able to just send money, it's like nothing new, right? And I think sometimes people often are looking for in their space and their solution, they're like, when they're looking at competitors, they're like, oh, what other startup or software solution like am I competing against? And this is a joke that I heard, I can't take credit for, but the joke used to be that the real competitor that all startups should have on their competition slide is spreadsheets. It's just a spreadsheet, right? The amount of business and stuff that just happens in the world off of spreadsheets is like incredible. And oftentimes you're building some app and the real thing you're fighting against is somebody just doing it on a spreadsheet, right? And I think the trick, or just doing it manually with like pen and paper, whatever, right? Those are actual competitors, right? Just because you are allowing people to do something not in a spreadsheet does not mean they're going to switch off of their spreadsheet. And it turns out in order to get people to switch from something that they are very used to doing already, it needs to be an order of magnitude better. It can't be like 10% better, right? Like, for example, this kills me. Madhu does all of his stuff in Excel, and I keep trying to get him into Google Sheets, and he doesn't switch. And you know why he doesn't switch? Google Sheets is not an order of magnitude better than Excel. I would argue it's like 20% better. It's not an order of magnitude better.
Shortcuts.
There's shortcuts in Google Sheets. Anyway, okay. Right. But like Madhu already knows how to use Excel. He has like muscle memory on shortcuts of Excel. So for him trying, I'm sure Madhu, you've tried to use Google Sheets at my kind of like encouragement, and you're just trying to do something. You're like, oh, this button doesn't work. And you just go back to Excel. That happens for all of your startups, right? And so the thing you have to think about is like your solution has to be like 3x better, 5x better, 10x better in order for people to really switch. And so I think that's the thing that we think a lot about when it comes to like looking at people's solution is like, is it significantly better than what exists? And it's not just like other startups. And so this is where the differentiation comes in and kind of like that kind of thing. And so anyway, the thing we're always asking ourselves is just like, is this solution kind of like an order of magnitude better, which leads to the differentiation thing. In our experience, in order to be an order of magnitude better, you need to have differentiated on something kind of like fundamental. And in order for that to happen. So if I just clone Excel, it's not order of magnitude better. Even if I like make better menus or like, I don't know, I make it 10% faster. People moving Excel from offline kind of like things that they pass around to online where it's like you can share and work on stuff together, that's an order of magnitude better, right? That's like a fundamental change in kind of like how people collaborate. And so there's kind of differences here. Okay, so I've talked about problem, talked about solution. Let's get to the founder part. People always ask us all the time, okay, like what do you guys look for in kind of founder? And by the way, unpopular opinion, if I'm ranking the order of which we care about these three things, it's this order. I think the problem is the most important thing when it comes to a startup. And then kind of related to the problem is like, is the solution kind of differentiated? Do they have like a novel approach? And then the founder. Look, I always used to think the reverse, because to me, I was like, oh, but founders, when I was a founder, that's the thing that matters most. It's like, you know, founders have heart and like, that's the thing that like matters, right? Like they're going to make this thing happen. The amount of my friends who are fantastic founders who have like not succeeded by kind of traditional sense is like super high. Like my most successful founder friends are not the founders who I think are the best at being a founder. Nope. Right. And oftentimes it's just because you have really good founders who are like working on a bad problem. Like they are working on a small problem here and they just kind of get stuck, and it doesn't matter how good they are. Right. Like, I don't know. Let's say you guys assumed I was a good founder. If I'm trying to sell heaters in Singapore, doesn't matter how good I am. I ain't selling any heaters in Singapore, right? Like, and that actually does happen in kind of startups. So I think of problem dictates the market. Market is the biggest pull. And then in order to win a market, you need to have a really good solution. And then founder kind of comes after that. So, and look, I think what ends up happening is if founders are like really bad, like they just can't get anything done, then none of this matters. It's like, they just don't get to pass the like minimum bar. But if a founder is like reasonably okay and they're working in a super good problem and they have a really good solution for it, it almost pulls like the founder out of them because they're like running so fast and they can hire all these people. The best way to put it is if you're working on a really good problem and you have a novel solution, it's like playing a video game on easy mode. And if you have if you're working on a problem that's really small and a solution that is not an order of magnitude better, you're just playing on the hardest difficulty. Like everything is harder. It's harder to grow. It's harder to hire. It's harder to like fundraise. Like everything is harder. Okay, but let's zoom in on founders specifically. A couple things we think about here. These all look like cliche kind of like bullet points. So let me kind of like be more specific so that they're not cliche. Every investor wants to invest in a founder that executes well. Okay, what does that actually mean? My definition of this, which is very straightforward, is does the founder do what they say they're going to do? Right. So during the batch, we meet founders on a weekly basis and we basically say, okay, well, like, what are you guys going to try next week to kind of like hit your goals? And they say X, Y, and Z. To me, the founders who execute really well, I meet them the next week and they do X, Y, and Z every time. Hell or high water, right? They don't have an excuse. They got it done. And founders who execute well do this just over and over. It's like a consistency thing. They like say they're going to do something, they do that thing, they figure it out, and they just keep going. So to me, as a founder, if you do what you say you're going to do consistently, you execute well. If you don't do what you say you're going to do consistently, you do not execute well. You execute sporadically. And so to me, that's kind of what execute well. Do you do what you say you're going to do or not? Okay, second point here is they need to be great communicators. I think, by the way, I didn't say have high charisma. I didn't say anything about charisma or anything like that, because I don't think that you can be a great communicator and not necessarily have like charisma or like a nice smile or whatever nonsense, right? None of that matters. Great communicators to me are able to talk to any number of people about what they're working on and kind of explain it to them and kind of convince them of things. So as a founder, you have to convince people to join your company. So I got to explain to Madhu why he should work at Iterative and why it's better than all the other places he should work on, which is a different kind of like pitch on how Iterative works. I got to convince all of you to apply to my accelerator and to kind of like do all these things. And that's a different pitch that I got to give to you. I got to convince LPs to give us money in our fund so I can invest in all of you. And then there's a million of other kind of things that we got to convince and communicate on. And each of those conversations are about Iterative, but from like a different lens and a different take. And I'm like having to kind of think about what Iterative is and then reformulate that into like, why should that matter to you? And that's what founders have to do with their products all the time. And so when you're like talking to people, they need to be able to kind of communicate. Founders who don't communicate well just don't get very far. Like, can't get a co-founder because they can't explain kind of what they're looking for, can't hire people, can't invest, can't get people to kind of, so there's just like none of that. And so as a founder, you need to be really good at communicating. And again, that doesn't mean charisma. There's lots of people who are kind of like, by the way, I'm an introvert. I know it doesn't kind of seem this way on this call. I'm an introvert. I like would much rather just be by myself, but like, this is just something that I've had to work on in order to kind of like work on companies and stuff. So anyway, you can be a communicator. The third one is internally motivated. So there's some people who are externally motivated and some people are internally motivated. Externally motivated people are people that care about like things that are outside of them. So I don't know, they want to be rich, they want to be famous, they want people to like have posters of them in wall, they want to be remembered, I don't know, all that stuff, right? But it all has to do with what other people think of them or do with them. In our experience, founders who are internally motivated tend to be more successful. Internal motivation is like, oh, I really care about solving this problem for some personal reason. Or maybe they really enjoy doing startups because they just think it's like really interesting. And it just is like something that they can like always work on. So it's something about them. The reason why this matters is startups are really hard. If you guys there's probably a lot of founders on this call. You guys know this. Being a founder is so hard. If you're just doing it to like, because you think you're going to make a lot of money. Oh God. I mean, 99% of the time you're just like, I'm going to come out of this with just like debt and like no money. So if you're really motivated by money, I just don't think you're going to last for very long. Like go work at a bank. It's like going to be better kind of like expected value on how much money you're going to make. And I think if you're internally motivated, like people can't take that away from you. Like if you love building stuff, that's why I do it. I worked on a number of problems. None of those problems were like, oh my God, they're my calling in life. I just really love building stuff. And as long as I'm building stuff, I'm kind of happy. And so I honestly got through parts of the founder experience that I probably should have quit, but I didn't quit because I just was like still building stuff. So I'm like, how bad can this be? And so nobody could take that away from me, right? It doesn't matter if 90 investors kind of like reject me. I still get to build stuff. So Okay, let me get to these last two parts. I'm mindful of time. Madhu, I didn't tell you this. I have Chinese New Year dinner at 7:30 in Chinatown. I'm meeting my girlfriend's father's side of the family for the first time. So
You can't be late.
I gotta get out of here. I gotta get out of here. Okay, curious. So I think one of the things hallmark of kind of founders is thank you for the luck. More luck, please. More luck, please. Thank you. Okay, more curious. I think is like a hallmark thing of founders. No founder understands their users. They don't understand everything about what it is. And so I think founders who are just really curious do better because they have this like inclination to like, oh yeah, why do people do this? Okay, yeah, why does this happen? Okay, like they just have a million questions and they're building this framework in their head about kind of like who their users are and why they care about it. So curiosity matters. Mischievous is my favorite one. I always think founders have a little bit of a mischievous streak. You got to be a little weird to want to start companies, and you got to see the world a little bit differently. And so we often kind of like look out for this mischievous streak. YC has a famous question in their application, which is, when have you hacked a non-technical system for your kind of like benefit? That's basically what they're trying to get at, is like when have you been mischievous, but like not broken a law, you know? Okay, founders. Okay, I think that's all I had here. So I can just like go to questions.
Okay. Shall we hit like questions?
Let's just hit it. Yeah.
Okay, cool. Do we invest outside SEA? Does it matter where the company is incorporated?
Yep. Okay, cool. So our thesis is for Southeast Asia. Now we've invested in Bangladesh like a couple of times, and I think like Pakistan once. We have looked at applications in other places, but the bar for us to make an investment in those other places is higher, and it's primarily because our investors in our fund would kind of look at us, kind of like give us a hard time if they saw that like we started investing in like half of the money in Africa, because we pitched them on Southeast Asia. So they're like, okay, I'm giving you money so you can invest in startups in Southeast Asia. I believe that that's going to be a good thing. We spend a bunch of that money in Africa, and they're going to be like, you didn't do what you said you were going to do. Like, that's kind of disingenuous. They have some leeway so that we can kind of like do like one or two, kind of like a few deals here and there, but that's the exception, kind of like not the rule. And so our bars are just higher. Incorporation doesn't matter to us. You can incorporate anywhere, that doesn't matter. So for everybody that's like, okay, I'm somewhere, but I'm incorporating in Singapore, we don't actually care about incorporation. It's more of kind of like, where is the company either based or where the target users are.
Okay. How is the funding amount decided? You know, we invest between 150 to 500K. So what are the main things we look at?
Yep. Basically, it comes down to, for the 500K, almost all the 500K are like making significant revenue already. Like, and by significant revenue, I mean like hundreds of thousands, if not like $1 million. So it tends to be on the upper end there. Most of our deals are in the 150, kind of like 200K. So I think the reality is just like, how far along is the company? Like, I don't know, if it was just ideas, if it was just an idea and we're betting on a founder, an idea, like we wouldn't do 500K on that. But if you're a company that kind of has significant kind of like revenue or something like that, then we would. But it's a case-by-case basis. Brian's not here. You basically have to convince Brian.
Yeah, he's the guy who's you're up. Yeah, you're up against him.
Yeah.
Okay, someone's asking, good question actually. If you're rejected for a batch, let's say early on, can you apply again, like in 1-2 months for the same batch?
Yeah, we've been kind of struggling with this because we want people to apply earlier. But oftentimes we can't like look at like the same application like many times. Here's my advice to you. My advice is, if you are going to apply for the same batch, but kind of later on, either send us an email, like you have our emails because we sent you a pass, and include kind of like whatever updated deck, but just highlight for us what has changed since the last time that we kind of like talked to you. The reason why we kind of like oftentimes tell people are like, look, we just don't have time to kind of like relook at an application, is because we just can't tell what has changed. And it just takes too much time to kind of figure out. So the best chance to kind of like hack this, if you're kind of like applying for the same batch, is like include an email or somewhere in the application, just like write what significant changes you've had since the like previous time that we looked at it. And then that'll help us kind of be like, oh, okay, we should like dig into this a little bit more.
I think that like probably clears a lot of things up for people. Okay, next one. this is on differentiation. This person's asking, like, what do you all think? Because you just said, hey, differentiation is like pretty important, but there's still like markets like BNPL where there isn't too much differentiation between like players. How do we think about this?
Not true.
Okay.
Not true. So BNPL can, okay, let's just like zoom in BNPL because I think it's like illustrative. There's BNPL for consumers, but even within consumers, it's like what type of consumers are they targeting? And then what types of products are they trying to do financing for? So a firm in the US was targeting large home purchases like mattresses and kind of like Peloton. So it was like $2,000, kind of like home purchases. That's what they were going for. I've seen BNPL kind of like target like home renovation. I've seen BNPL target kind of like, I don't know, like small everyday things. So I've seen like, you can differentiate based on kind of like which target user you're going after. You can also differentiate based on underwriting. You could just be better at underwriting kind of like risk than the other people, right? Now you got to have a thesis for like why you're better than other people are kind of underwriting the risk, but you could have a thesis on that. Some people do B2B BNPL. You could also be much better at raising debt financing than other people in BNPL. Like BNPL is you have to raise kind of like debt so that you can give it to other people. You might be better at raising debt. And so your cost of capital in order to kind of like get is just lower than everybody else. Like if I have to pay 3% of the debt that I borrow from some bank to give to my customers, and Madhu has to pay 1%, he has a better business than me, right? So there's actually lots of ways to kind of like differentiate.
I think that was a really good answer. Like if it seems undifferentiated on the surface, you probably just got to dig in and find like your wedge.
Yep.
Okay, that's awesome. For Web3 companies, is it like only, the typical equity style of investing, or, do we invest in like tokens?
We haven't yet. I mean, I think we'll like look at it, but like we typically like investing in the like company itself. But this is something that like people are looking into, kind of like interested in and that kind of stuff. So we haven't done any token investments. And I think it would take some work for us to kind of figure out how to do it, but never say never.
Related question. How do we invest? Do we invest via safe?
Yes.
Safe notes?
Yep.
Okay.
And we're pretty flexible with that, by the way. So I don't know, people have kind of like different instruments. I don't know, sometimes people use YC Safe, they have their own safe, but yeah, pretty standard terms. It's kind of across, but yeah, convertible.
Yeah, our CFO is like a rock star. Like she'll help you, with whatever issue you have. So
she really will.
She'll get like kind of like take care of you once you apply.
Shout out Mag, who's probably not here, but shout out Mag.
Shout out Mag, yeah, superstar. Okay, next question is, I think it's pretty good. Can people apply as a solo founder, and what if they're non-technical?
Yeah, I've invested in solo non-technical founders altogether. I think, yeah, Logan from Marty was, he was pre-product solo non-technical. So he was like
all the minorities.
Yeah, I was gonna be like, give Logan's cool. I was gonna give my, he like is like red flag bingo for investors, right? It's like, pre-product, not technical, solo founder, and we're just like, yeah, let's do that. Look, these are all kind of like signals and stuff, and so we kind of we take a holistic approach and kind of like look overall. So just because you're a solo founder, it's not like you're automatically out. Just because you're not technical, it doesn't mean you're automatically out. Like there's nothing that kind of automatically excludes you. Oh, full-time. We only invest in people who are working on their idea full-time. So maybe there's one.
Yeah. He was working a full-time job, and like he quit immediately.
Yeah.
So
but because I get this question a lot, he quit before we invested, because I told him we don't do the thing where it's like, oh, if you invest, I'll quit my job. No. Right? Like you need to believe in your thing enough to kind of like take on that risk, and then we can kind of like decide what to do. So he quit his job and then we invested. But no, we don't have any kind of like red flags that way. Again, I think go back to the other part where it's like, if you are non-technical, you can actually validate an idea as a non-technical person pretty easy these days. And so don't let that hold you back. As a technical person, I don't even validate ideas by writing code anymore, even though I can. Like, it's just not the like fastest way to do it. So, but if you are a solo founder, non-technical, all this kind of stuff, lots of things you can do. I think just work on kind of other parts of the application, like work on your validation, differentiation, all that.
Okay, another good question, which is, do we invest in competing companies that are backed by Reddit, but maybe working on a different geography? Is there a different process?
Yeah, there isn't a different process. Okay, when we first started, the answer was like, we definitely don't invest in competing companies, even if they're in different geographies, because we were like, oh, they're going to run, they would run into each other at some like long stage. We just want to avoid that. We're getting to the size now with our portfolio where this is like borderline inevitable at some point. And so we are mindful of it. We try to identify it when it does happen. But we are open to kind of making those investments. Likely what would happen is we try to make sure that there is like some level of kind of like insulation between those companies. And what I mean by that is if I work with Madhu on his company and then I
Like a
wouldn't
China
work,
wall between partners who
yeah,
work with you.
I wouldn't work with kind of like the competitive company, like Brian would work with them and we wouldn't share notes and we would try to kind of do those kinds of things. We look at competitive companies and stuff because we think at some point we're just going to like end up running into companies. So it's okay.
Okay. Any reasons we have passed on companies that we think have a great problem or solution? Like, is there any other red flag? I mean, problem, solution, founder, probably one of those three, right?
I mean, there's a million reasons within each of those on why you wouldn't invest, but like it basically all boils down to kind of like one of those, I think.
Yeah. Okay.
But there's a million reasons in each of those, right?
This is a good one. What are the reasons they'll make us want to, like, let's say, click that start button in the application, right? And invest later versus invest now?
Oh, great question. Okay, a couple of things. One is sometimes we meet founders who we just really like, and maybe I should have left this up, but basically they kind of tick a lot of the boxes that we're looking for, right? So they seem super curious. They kind of feel like they're doing it for the right reasons. The word that you'll hear at Iterative a lot about founders is, and this is like one of the highest compliments I feel like we can pay founders is, oh, this founder is really earnest. That's like one of the highest compliments. And you guys can look up the definition of earnest if you haven't kind of seen it, but it basically is like kind of does things for the right reasons, which, you know, is kind of subjective, but like that's something that we kind of care a lot about. So sometimes we'll just meet founders where we're just like, I don't love the idea, but I just feel like this person is earnest. They're really curious. They're like working on all the right stuff. I just don't love the idea. And in those cases, I've actually sent emails and been like, hey, we really like you. We don't love the idea. If they're super early, we're like, are you working on any other ideas? Like anything else you got going on? Like maybe we can kind of like talk about that. So sometimes there's that. Sometimes we star companies, which more for the company. And the reason why we would do that is somebody talks to the company or is looking at the application and there's something that is unexpected but interesting or something we didn't know. So sometimes like I talk to a company and I mean, I frankly never know as much about their spaces as they do, but sometimes they'll say something that is like, I'm just like, oh, I've never thought about that before. They have like some observation where I'm just like, that can't be true. And they'll be like, it is. And like, they'll be like talking to me. I'll be like, no, that can't be true. And they'll be like, it is. And then I'll just start thinking about like, oh my gosh, if that's true, then this is true, then this is true. And like, the world is kind of like different. And so in those cases, I'm kind of like, hey, can you validate a little bit more? Like, can you talk to me about this? Hey, like, and so I like kind of want to keep up to date with them. Good examples of this, I'll just use canonical examples. Airbnb is this, and we talk about secrets all the time, but like Airbnb, if they applied to Iterative, would have been like, oh, we like make it so you can rent at stay at people's houses. And I would have been like, nobody wants to stay in people's houses, right? And then they should probably show me their like growth chart at some point. It was slow in the beginning, but it's like, oh no, look, see, these people really want to stay in people's houses. And I'm like, why? Like, and like we would go down that whole thing. And so I think sometimes for companies, it's just like they have an interesting observation I've never thought of before, or like just like can't be true. And so we're just like, we ourselves are curious. We're just like, okay, like keep an eye on that.
Okay, maybe the last one before we let you go.
Mhm.
How much equity do we typically take, and how do we value companies?
I think it's the same kind of as writing kind of like the docs. I think we basically, the way to think about it is we invest about 150. We invest 150 to 500K. We try to get anywhere between kind of like 8 and 10%. So I think that's the like rough frame that you should kind of like do on. Maybe we should post this at some point. We have a document to how to think about kind of like dilution. And the way that I always kind of think about it is, look, you want to kind of be sensitive to dilution. So I get it as a founder before. But I do think sometimes people can over optimize you can definitely under optimize for dilution. Sometimes you can over optimize for dilution where it's like, you own a lot of your company, but like kind of not going anywhere. And so like that's another to think about. I think Paul Graham wrote an article about this, which is basically like if you're giving up 10% of your company, so you own 90% of the company, the 90% that you own should still be worth more than the 100% from before. And so is the person you're giving 10% to going to increase the total value of the startup such that your 90% is still worth more, right? So Madhu owns 100% of $1 million company. He lets me invest 10%. He now owns 90%, but if that company is worth $2 million, his 90% is now worth 1.8 million. Would you rather have 90% that's worth 1.8 million, or would you rather have 100% worth 1 million? Right. So there's like things to kind of like think about with these things. And so I think that's the way that like we tend to like think about it. But lots of conversations about this and situations and that kind of stuff. Dilution equity is quite sensitive. I know, I've been there.
Okay, I think we can close it out actually. Yeah, I think we can close it out. These have been like pretty good questions. And thanks everyone for coming.
Maybe let me say one last thing just to close out the equity thing. Sorry, I know you're trying to wrap this up for my benefit. Just because people are asking about kind of like equity and kind of deal terms and this kind of stuff. We invest the full amount, and I just want to make sure this is really clear because not all accelerators in Southeast Asia are like this. We invest the full amount right like as soon as you're accepted, and we transfer the money before the program even starts, like full amount. So we don't invest in tranches, we don't do any of that nonsense. If we want to invest in you, we transfer the full amount of our money right then and there. Furthermore, we have no clawbacks. Like once you get our money, there's no way for us to ever get it back, right? We are like with you, we're riding with you on this, like that's it. There's been times I've wanted to, but like we don't get it back. We also don't take board seats. It's your company. And you don't frankly have to listen to anything we say. Like there's actually nothing in the rights that says you have to like do anything we say. So there's no clauses that like does it, like we invest fully up front. We also don't charge a program fee. So we invest, 250K, you get 250K. That's it. No program fees. We don't take something off the top. We don't do any of that kind of stuff. The reason why we do all of this is we want to align everybody. So if we invest in tranches and then we start working during the program, you're not going to actually be that honest with me because you're going to want the rest of my investment. So what we're trying to do is we want to invest all of the money right up front in good faith, and then we want to get to work. And so the first office hours is often like let's say it was Madhu. I'm like, Madhu, you get our money? And he's like, yep. And I'm like, cool. There's no way for us to get it back, right? Like zero. Like nothing we can do to ever get that money back. It is your money now. As a founder, I also know that 85% of your pitch is bullshit. You don't necessarily believe all of that. You don't totally know about this thing. I've been there. My pitches are this way too. It's fine. We all did the song and dance. Now you have our money. Like, let's get to work now. And the thing that they always kind of say is that like the founders always kind of like pause and they're just like, oh my God, is he serious? And then I'm like, I'm serious. And then everything comes out, and founders will all know this. The number of times that I've like pitched things that inside when I take a shower and it's just by myself, I'm like, I don't know if I believe this and I don't know if it's true, right? And so all of that stuff comes out. I don't actually know how to do growth. Like, I don't know how to do this. And so all this stuff comes out. And so we just think that if we do the full investment and we align all the incentives up front, then we can kind of like dig into these really core problems. And if we do it in tranches, we have clawbacks, whatever, nobody's ever going to be honest with us. So we try to do it all up front. So that was the last thing I want to say. I just want to clear out kind of like details on that.
That's awesome. Any final closing words before we kind of like wrap it up?
No. Application deadline is on the 20th. If you apply before the end of day 20th, we will guarantee kind of like get back to you about your application. The batch starts on February 6th or 6th of February. And so it is coming quickly.
Oh, one thing. Yeah. By now in all your inboxes, you should have received an email from me with a special application link. If you apply through that, you kind of like skip some of the very long application form, and you can kind of like get a bit of a pass. So as a thank you for coming to this, fill in your application using that form, and we'll make sure you kind of like get through before the 20th so you can get a response in 14 days. Okay, that's all. Okay. That was my plug. Okay, I'm done.
Good plug. Thanks everybody for coming. Wish me luck in family meeting dinner. Thanks everybody.
Yes, all the best. Bye-bye.
See you guys. Bye.